Alright, Chapter 6, we're going to look at receivables and inventory. So the first thing we're going to look at is the common classifications of receivables. So what accounts receivable is, and we've kind of touched on it in the first few chapters, is credit terms extended to customers. So an example of accounts receivable would be Joe's Lawn Service. If he does some work for a customer in August, but doesn't get paid by that customer until September, the time between when he does the work and he records an account receivable because the customer owes him money. So he extends credit terms because he didn't get paid cash right when he did the work. He sent the customer an invoice so he was going to get paid later. So that's accounts receivable. A note receivable is a more formal agreement. It includes a maker and a payee. So that would be a car loan or a mortgage on your house. It's a formal agreement. It's a long legal agreement. And the two parties, the maker and the payee is the one who's owed the money, and the maker is the one that makes the loan. And there's some other receivables, interest receivable. So if you're, say, a bank, and you loan money and somebody owes you interest on that money you loaned them. Well, they owe you interest, so that's interest receivable. If you're a government agency and businesses owe you taxes, taxes receivable. So here's an example of a note receivable, which we recall as a formal agreement for a receivable. So if we look at bullet 1, we have the maker, which is the treasurer of Selig Company, H.B. Lane. We have the payee, which is the Peerland Company. And then the face amount you see is $2,000. That's the amount of the loan. The issuance date, March 16th, 2012, and the due date is June 14th, 2012. So that means it's about a 3-month loan at a 10% interest rate, bullet 7. So we'll look at the nature, how we're going to do accounting for uncollectible receivables. Probably ask yourself, what if the customer doesn't pay? So Joe Lawn Service, he does some work in August, he sends the customer an invoice. What if they never pay it? We create our accounts receivable on our balance sheet for the work that he did. Does that accounts receivable sit there forever? If the guy doesn't pay, what do we do? So the answer to that is we must recognize an expense for uncollectible accounts. It's called bad debt expense. So Joe's Lawn Service, that work he did in August, the guy hasn't paid his invoice yet. Eventually, it'll be deemed uncollectible, and we'll recognize expense on our income statement for that debt that can't be collected. So there's two ways we're going to look at to calculate this bad debt expense and recognize expense for uncollectible accounts. The first one is the direct write-off method, which is typically used for smaller companies. The other method we're going to look at is the allowance method, which is usually required by GAAP for most larger publicly traded companies. So the first one we're going to look at is the direct write-off method. So what the direct write-off method tells us is that the receivable is written off when the account is determined to be worthless. What does that mean, determined to be worthless? That means it can't be collected. So Joe did some work for ABC Company in August. He sent him an invoice, but he found out the owner of ABC Company fled to Ecuador. Well, that invoice is uncollectible. It's worthless. So under the direct write-off method, we're going to write it off. So if the invoice is $4,200, let's just say, we're going to reduce accounts receivable by $4,200 because that $4,200 isn't going to, we determined it's not going to be collected. So we have to take it out of our accounts receivable. And then on our income statement, we're going to show expense for $4,200 under bad debt expense for that uncollectible invoice. And then we know expenses reduce retained earnings by $4,200. Well, here's another scenario. Joe's Lawn Service did that work for $4,200 in August. The guy fled to Ecuador. We determined the invoice was uncollectible. We wrote it off. But then he comes back 6 months later and decides to pay his invoice. So what do? We reverse the write-off entry that we did. So we add the $4,200 back to accounts receivable. We take out the $4,200 of expense from the income statement. So we reduce expense, and then we add it back to retained earnings for $4,200. And then we record the invoice as normal. So we sent the check for $4,200, we increase cash $4,200, and then we reduce accounts receivable by $4,200. So if he comes back, he decides to pay later after you wrote it off, you reverse the entry you did to write it off, and then you record the payment as normal.